the things that we use specifically in our multi-factor portfolios is what we call normalized trend levels. Now, this is a little bit technical and it's a little bit for the pinheads of the crowd that want to know why we make decisions and how we make decisions. The little green line is a bunch of stuff that is a 0 to 100 indicator. In other words, half of it is a stochastic, half of it is an RSI. And if anybody wants to know, you can call Tyler at our office and he's not going to tell you. So you can call him though and ask. What we do is that we know that anything we have, I'm not sure what this is a chart of, probably the S&P 500, anything greater than 50 is in an uptrend. Let's take a look at that. Anything above 50 is probably in a pretty strong trend. Now, if it's less than 50, is in a downtrend. Look to the right edge of your marker over there. You see the 50, and you can see that the market is probably as a general direction is going down. But also, let's look at 60. This is what we call a strong uptrend. 50 is up, 60 strong. This is an overview of how we make things fit. It's normalized. We normalize the trend on anything that we look at that we could make a decision on. It's a way that we compare things. And I got a great story to tell you about how do we get to 0 to 100? Well, we have a lot of UGA grads and interns and one thing and another. And the makeup of the indicator is two indicators that have 0 to 100 levels. So if you took it and just said, we're going to add the stochastic and it's a 0 to 100 level, it has a value. And then we got an RSI and it's a 0 to 100 indicator. But we had a lot of difficulty going way back a few years ago. So we decided to take our indicator and divide it by 2. So it really helped the UGA grads. It really put them in a perspective and they've got it now. So we change a few things, but we never change our strong trend, uptrend, downtrend rules, and we're never going to change it from going from 0 to 100. Saves us a lot of time, energy, and we can get them working a lot faster. Okay, let's jump through. Here's another example. Again, this is SPY, a different time frame, but let's just view those down markets over there. An awful lot of that time is below 50. So we think that's going down. Let's look at the other down market to the right side of your screen. But clearly, when we're generally above, these are long-term markets. So I just want to make sure that you understand. Above 50, the trend is up. Below 50, the trend is down. Above 60, we're in a really strong uptrend. This is a picture of AGG, which is the total bond market. You can observe that on the right side of the screen, it clearly indicated we were in a down market for the bonds. And they weren't just down, they were submerged. In fact, I think we can probably say at the low point of the bonds, and I'm not sure of the exact date on that, maybe October, November, it wiped out all the gains from many, many years going back. So it held true with the index, a bond. Let's look at the right-hand side of the screen. We think that anything above 60 is in a strong uptrend. And that, my friends, is a pretty strong uptrend. And so this is a high yield bond fund. Look at the same thing. When you're above 60, direction's up strongly. No matter whether it's an index, a bond, or a junk bond, or just about anything. But also on the right-hand side of the screen, below 50, it's not very helpful to be in the market there. So how do we utilize these normalized trends? We typically evaluate our positions that we own once a week, and we have a ranking. Let's just assume that we're going to hold a position in momentum stocks. And so we rank all of our momentum stocks. We, at that point in time, find the absolute trends that could be anywhere from probably the ones that we want to purchase have to be above 60. We like to let other people's money get it to 60, and then we participate. Sometimes it forces us to buy at all-time highs. We have no problem with that because Once you get a trend going, it's pretty easy for people to start bidding into it. We just take the ride as long as we can. But we'll never own anything below 50. Those are rules that are written in stone. Everything we do is framed inside of a 0 to 100 measure. And therefore, as we do our ranking, it makes it pretty easy for us to not just manage what we have, the stocks that we might own, but we can find new ones that are coming up as our older ones fail to meet our criteria. Pretty simple. Thanks a lot.